Okay, so today we're going to look at the money supply. So we learned about money last time. Today we're going to kind of look at money a little bit more. I like to say we're going to go into banking, but we're not. We're going to basically kind of go from here to here, but just briefly. Banking we're going to do next class. As far as money, we're going to look at money supply and the money market. It's the last graph in AP Econ. Woo! So it's the money market graph. Yep, I know what you're thinking. Okay, that scared me. I'm sorry. Yeah, no, I think you hit the bottom button. Okay, money market graph. So what's it going to look at? The supply and demand for money. I'm just waiting for everybody to copy it down. Okay, so demand for money. We need money. People demand money for two reasons. At any given time, we need a certain amount of money or some type of liquid asset, something that we can use as currency to exchange so we don't end up in the barter system. But we need an illiquid asset for us, money, for two reasons. One, for transactions. We have a transaction demand. I want to buy stuff. I want to buy a shrimp burrito on the way home. I like my bagel in the morning. I need my coffee. Transactions. People hold money every day for transactions. Same reason we'll say that we hold money in our, because this, I'm talking about cash, I guess, but we can also say that we hold money in our checking account, which is considered M1 money, for the same thing. You could take that money in your checking account. Instead of having it in your checking account, you can invest it somewhere, stocks, bonds, real estate, whatever. Or you can leave it in your checking account. That way, when you have your debit card, you can swipe it, you can use it. Transaction demand. We also use money for assets. People hold money since it's less risky than other assets. If I know that, hey, I got some money, I can either convert it over to something that's going to generate more wealth, like a stock or a bond, or I can just hold it in my pocket for a couple of days because I know I'm going to be using it again later. I know it's going to hold value, whereas, maybe I don't invest it in something else that may lose its value. So asset. And since we're talking about a graph today, there's going to be one thing in favor of another thing. So we're going to have opportunity cost. So what's the opportunity cost of holding money in our pocket or our checking account? The hint is our pocket and our checking account don't collect interest. So what's the opportunity cost of holding money as cash or in a credit card? What is it? Ooh, boom! The opportunity cost is not collecting interest. If I've got money in my pocket, my money's not working for me. But if I invest my money in stocks or bonds or real estate, mutual fund, that money is going towards something. So the opportunity cost of holding money in my pocket or a checking account, both of these, currency and checkable deposits, count as M1 money. They don't they don't collect interest, and so my opportunity cost is any interest I'm giving up. So the interest you could be earning from other financial assets like stocks, bonds, and real estate. That's what I'm giving up when I'm holding cash. You got it. What are they called? Candy canes already? Guess so. They were talking about the economics of Christmas music this morning on the way in because Christmas music gives people anxiety and they feel the need to spend more money because when you hear it, either you get in the spirit of Christmas and buy more money because you hear it, or Christmas music increases your anxiety and you realize I haven't bought the Christmas presents I need. So stores are playing it all the time. And if you work in a store, it can also increase your anxiety because your workload during the winter season is much higher. And so workers typically dislike Christmas music. Huh. And the smell of peppermint encourages you to spend money because it also associates with the season. So in Las Vegas, underneath the slot machines, they spray peppermint because it reminds you, your olfactory glands is the most memory provoking of all your senses, and you smell peppermint, you think of Christmas, and you keep playing the slot machines. Isn't that crazy?
They used to do the same thing at Disneyland. Like they make it stuff smell like candy and stuff, like make people think they're happy and like want to buy stuff.
That's awesome. That's really awesome. Okay, so if we're talking about opportunity costs, what do you think is going to happen to the amount of money or the quantity demanded of money when interest rates increase? If interest rates are really, really high, do I want to keep a lot of money in my pocket? No, I want that money working for me. I want to collect that interest. As a person who can invest, I want to generate as much interest as I can. When interest rates are high, I don't want to waste money or waste earnings with money in my pocket. I want to put them in an interest earning asset. So the quantity demanded falls because individuals would prefer to have their money, their illiquid assets, as as interest earning assets. I don't want cash when interests are high. I want my money making money. And the opposite is true. You can just write the opposite is true. What happens to the quantity demanded when interest rates decrease? If interest rates are almost nothing, why bother making the effort, right? Why invest in a bond that's going to mature in 10 years? And if I need the money, I might go out and find a bond broker to sell it in the bond market. Then I can get access to the cash, all for a really, really tiny profit. I don't know if that's worth it. I might just keep my money in my pocket. So when interest rates are low, the quantity demanded of money is high because you don't want to switch back and forth between liquid assets and illiquid assets. So there's an inverse relationship between interest rates and the quantity demanded of money. And everyone's reading this right now and are thinking to themselves, are you serious? We're going to have our last graph is going to look like every other freaking graph we have? Yep. It's a downward sloping demand curve. Get excited, my friends. Woo. Downward sloping money demand curve. Are we ready for it? No. Sorry, too fast, too fast. Yeah, you have to look at interest rates on what's your intention. When the interest rates are high, you don't want to borrow. But when interest rates are high, you want to lend. So this is where right now we're thinking of it as far as borrowing. We're thinking about lending, but monetary policy is going to affect the lending side. What's the question about interest rates? Interest rates are high and they're going higher, so people are getting nervous. Why? Because they're trying to slow down the economy. Like right now, our economy's been growing so fast. We're not in an inflationary period yet. What? Yeah, you want to take out less loans when the interest rates are higher. But right now, since we're approaching an inflationary period, the Fed is trying to act early to kind of counteract it and bring it down. Okay, going for it. What do we have on the y-axis? We have nominal interest rate. You can just call it NIR to keep it simple because this is the graph with the largest axis name. So nominal interest rate. And then quantity of money demanded, I just call it Q with a dollar sign. On the AP exam, write it all out. But for the sake of us, Q with the dollar sign is just fine. And then interest rate, you can just call it IR. As long as you remember it's nominal interest rate, we're good. You ready for the money demand curve? Bam! Bam! Inverse relationship between interest rates and the quantity of money demanded. And this is looking at the point of view of you looking after your own money. This isn't us taking out loans. This is us investing. When there's 20% interest rate, I don't want to hold a single penny in my pocket. If I know that I can get a return on my investment of 20%, I'm putting all my money into a stock, a bond, or real estate, whatever it is that's going to give me 20%. I'm putting it all there. I'm not having an extra dollar in my pocket because that's huge. So quantity of money demanded in our economy, in our pocket, in our checking account would be really small because it all should be somewhere else collecting 20% interest. But if interest rates are really, really low, it doesn't make any sense to spend the time to get a stockbroker, a real estate agent, look at the bond market, research companies. The interest rate, the return on your investment is so low, I'd rather just keep the maximum amount of money in my pocket, in my checking account. I don't want to go make the effort of exchanging it and bopping it around. Yeah, this would just mean this would be a ton of money chilling in my pocket over here. Yeah, or in your checking account. Nowadays, we don't keep money in our pocket. It's in our checking accounts. We use our debit cards. All right. So guess what? All right, you take a towel. If we've got a curve, what do we need? If we have a curve, what are we going to have to need to go with it? Shifters! Oh, yeah. So what happens if price level doubles? If, for example, things that used to cost $5 now cost $10, do we need more currency floating around in our economy to pay for it? Yes, we do. So that's a good example of what a shift in the money demand curve would be, an increase in the money demand. So what would shift us? Price level. If there's inflation and price level doubles, we're going to need double the money. Instead of having $200 billion of currency floating around in our economy, we probably need $40 billion floating around in our economy. That way we could cover the transactions. What if there's changes in income? If all of a sudden, if our nation is richer, are we going to need more money? If you get richer, what's the first thing you do to yourself? You treat yourself, right? And so we need more money. So check it out. How will they express that in an exam? They're going to show us an ASAD curve, AS with an AD and a long run. And let's say, for example, consumer spending increases, our aggregate demand shifts to the right. This was a QY, and this is a Q1. Our GDP grew, right? Our real GDP grew, but that's because consumer spending increased. If consumer spending increases, does that increase our population? No. And we're not going to just pop out more kids because we all bought PlayStations, right? Stay with me here. Stay with me here. So if our GDP grows, but our population stays the same, does our real GDP per capita grow? Yes, because GDP per capita is GDP divided by population. So if our GDP is growing, but our population is staying the same, is it safe to say that our economy's income is growing? Yeah, we are all getting richer. So you're going to get a graph and you have to respond to something like this. So you'd have a unit 3 question like, say, for example, investment spending in the private sector increases, show the effect on aggregate demand. You draw out the aggregate demand. Judging by your findings in your previous question, if output progressed from QY to Q1, what effect would that have on the money demand curve? You'd say, oh, okay, GDP grew, income as a nation grew, therefore money demand shifts to the right. See how that's played out? Cool. Third one, but I've never seen it anywhere, changes in technology. Any one of these, like if there's an increase in price level, it's a right shift on money demand. Increase in income, right shift in money demand. If there's an increase in technology, it'll be a left shift in money demand. Why? New technology reduces our need for currency or M1 money. If you need to wire money to a friend, we have new technology. You have Venmo, you have Android Pay, you have Apple Pay. We have credit cards. Credit cards aren't money. Credit cards, when your credit card swipes, you're signing a contract that you're going to pay your credit card company. The credit card company is actually making the transaction for you. You have to repay them. That doesn't count as money. Venmo isn't actually, is Venmo checking to checking? Okay, so that actually would. Do you charge your card or is it directly linked? Okay, so that one might still count as money then, but some of them, like Bitcoin's example, that's an increase in technology, but a decrease in the need for money if you're putting your money in Bitcoin. Never seen it on a test, just throwing it out there because that's one of our shifters. It's never showed up on anything that I've ever seen, but just throwing it out there so it's there. So let's practice it with the partner sitting next to us. The amount of money that the public wants to hold in the form of cash will A, B, C, D, or E with our partner, and then we'll do it in ASL. A, B, C, D, or E. I'm definitely gonna get right up there. I want to get the hand drawings. Do I have any artists in here? Hand drawing artists for like the contrast. Yeah, highest best drawing gets extra credit. No, best drawing gets extra credit for their whole class
What's the drawing of? What do we draw?
of our hand. Get a hand model like Zoolander. Okay, what do you think? Hands low, make the shape. You got A, B, C, D, or E. 1, 2, 3. You got the hand up. Would you ask what? C. The amount of money that the public wants to hold in cash will decrease if the interest rates grow because why? You want to cash in on those interest rates, make the profit on your own money. All right. So if we have got a demand for money, what do we need? Supply for money. Yay, here we go. But guess what? It's a special one because the money supply is set by the governor of the Federal Reserve Bank. Did we watch that video in here? We didn't watch my Fed movie? Oh, okay.
Yes, we did. We did. Yeah.
Yes, we did. All right. So the amount of money in our economy, you got a cameo. No, that's okay. Cameo. The amount of money in our economy is set by the Federal Reserve. So, whoop, it's going to be a vertical. See, look, it's a brand new graph. You guys were worried it was going to be the same old boring supply and demand, but look, this one's got a vertical. Yay! Thank you. It's made my day. Whoop. So the U.S. money supply is set by the governors of the Federal Reserve System. Since we didn't watch the documentary in here, we can say that the Fed is a nonpartisan government office that sets and adjusts the money supply in the economy. Each member of the Fed holds a term of 14 years. That way they're not swayed by political opinions. It's not supposed to exist in any way relation to the government. Like the Fed does not earn any money from, does not collect a federal budget from Congress. They generate all their own money from interest on selling government securities. Why? Because if the president or Congress didn't like what the Fed was doing, what could they do? They could cut the funding to the Fed, and therefore politics could affect the Federal Reserve. Because if you're a president, the last thing you want to do is have maybe the Fed start contracting the economy during your presidency. Even though it could lead to inflation, presidents like to have a booming economy under their control. And the Fed is really going to be the one that's going to be tightening up an inflationary gap because, well, nobody wants to use fiscal policy to contract the economy. That would increase taxes and cut government spending. You'd get voted out. No one's going to get reelected for that. So the Fed plays a big role in raising interest rates to curb it. They call this monetary policy. Monetary policy. Okie dokie. So that I'll just fill you guys into later. That's the old film I used to show. So what does the Fed do? They manipulate the money market to affect change in their economy. Today we're going to kind of preview what monetary policy is, and we'll build on it on Friday. But If our money supply is sitting here at $200 billion and the current interest rate in our economy, and we don't just say an interest rate is 5%, it's interest rates all vary depending on what you're going to get, what your credit rating is it business, is it private, what's it for, etc. So this is just to get an idea of numbers so it sits in our brain. But what happens if the Federal Reserve decides I'm going to increase the money supply? I'm going to move the money from $200 billion of M1 currency floating around and cash, currency, checking deposits, traveler's checks. Let's grow the money to $250 billion. That means they're increasing the money supply. And at 5%, if there's more money floating around, it's easier to get a loan. You don't need to get a loan. There's more money out there. So banks would have a surplus of loans at that rate. No one's taking out a loan at 5% because the money supply has grown. So banks would slowly start dropping their interest rates until they find a new equilibrium. That would be right here. So when the Federal Reserve decides to increase the money supply, what they're effectively doing is dropping interest rates. Why would the Fed ever want to drop interest rates? What's the point of dropping an interest rate? Yes. Yeah, because if interest rates drop from 5% to 2%, well, all of a sudden, if I'm a consumer and I'm thinking, hey, I want to go to college, but man, we did this thing where we figured out how much USC was going to cost after 30 years. It was over $1 million at 80,000. Oh my God. I don't know if I want to go. Hey, wait a minute. Did you say the interest rates dropped to 2%? Hey, maybe I will go to college. Maybe I will buy that Ferrari. Maybe I will take out a loan to buy a sit-down lawnmower. Wouldn't that be kind of fun? You need a bigger lawn, but it'd still be fun. You'd encourage consumer spending and you'd encourage business spending because you might invest to buy more robots. If you're GM, maybe you get a new factory. Too soon? Nah. But what are they doing? They're growing the economy. If you increase C or you increase I, what do you do to aggregate demand, Emmy? Boom! You guys ready for a flow chart? Flow chart. If you increase the money supply, you're going to decrease the interest rates, which means investment increases. C went up, I went up, and as Emmy said, boom, aggregate demand is going to shift to the right like a boss. Boom. There's your expansionary monetary policy. Increase the money supply, decrease the interest rate. That increases our investment, and that will move our aggregate demand to the right. Is someone not shy to be on stage? Thank you. Come on up. How do I increase the money supply? Kate, you have this awesome bond. Welcome. So you've got this bond. It's a 30-year bond. I want to increase the money supply if I am the federal government. So what do? I buy your bond. That doesn't count as money, right? It's just a financial asset. Can you spend it? No, I can't do anything with it. Can I sell it to you for $4,000? I mean, can I buy it from you for $4,000? Yeah. So I'm going to give you this. I take the bond back. I'm going to burn this thing, tear it up, do whatever I want. You have $4,000 that just got injected into the money, into the economy. What do you do when you get money? Yeah, treat yourself. So you'd buy something, they'd buy something, they'd buy something, and we just grew the money supply. Thank you for being a volunteer. I appreciate it. All right, so let's take a look at the flow chart of how it would work in the opposite. Thank you. In the opposite, if the Fed decides, hey, I need to slow the economy down, what do? I decrease the money supply. When I decrease the money supply, there becomes a shortage of money. Where do people get money? From banks. If there's a shortage, banks are going to recognize the shortage, and they can raise the interest rate until we have an equilibrium at the new money supply and the money demand curve. So they effectively raise the interest rate. If you're looking to go to SC, and we calculated 4% of SC at 30 years is $1 million, and now it's going to 10%, goodness, you want to go to SC? I'm going to pick on a new school because I know someone in here is really excited about SE. Do you want to go to Pepperdine? I'm I'm pretty sure Pepperdine's probably about the same amount of money. What is the most expensive college? NYU, maybe? Well, cost of living in New York would be pretty high too, but NYU would be cool. Okay, so let's just assume now interest rates are really high. You're not going to buy your Ferrari. You're not going to buy your new house. You're not going to buy your sit-down tractor mowed lawn driver. Lawn mower. That was the word I was looking for. So C would drop, I would drop, and aggregate demand would decrease. So wait for it. If you decrease the money supply, you are raising interest rates, which means that you are going to decrease investment. Consumers aren't going to invest, businesses aren't going to invest, and that would bring aggregate demand to the left. This is getting us out of an inflationary period. Who's feeling fancy from this side of the classroom? Totally Daniel. Oh, was it you? Oh, come on up. All right, so you don't have to if you don't. Are Sam, you get in on this? Oh, you thought you got saved. Okay. And this time you've got a lot of money sitting here. I want to get this money out of the economy. So I want to entice you. Thank you for showing up with $4,000 today at school. Where do you park your car? No, I'm just kidding. So you show up with $4,000. I'm sitting here thinking, I've got this bond. I'm willing to sell you this bond that's going to generate 6% interest over the next 10 years. It's a pretty solid investment considering we don't know what the stock market's going to do tomorrow. We want to buy this bond? Yeah. So $4,000 gets extracted out of the economy. What should I do with it? Shred it, right? I'm the Federal Reserve. I want to decrease it out of the money supply. How many did I get in the trash can? Dang. I'm going to drop it out. What if he wire transferred to me? I get this wire transfer that says, oh, the Federal Reserve Bank just received $4,000. I take that 4,000 and then highlight it, type in a zero. Money is poof, gone, like Kaiser Soze. That money just dropped out of the economy and you have a financial asset. Now, anything that you would have spent that money on is not going to get purchased. Those people aren't going to receive that income. They're not going to purchase more stuff and so far. So we extracted 4,000 out of the economy. That's how I shrunk the money supply. Thank you for playing. Yes.
Would there be a possibility that someone of high level in the Fed just takes all of our money and just puts zero, and then our whole economy is just zero?
There's this thing called backup. Yeah. In fact, Kodak and Fuji are still arguing in Japan over who holds the rights to the electric tape, not the magnetic tape. Remember like cassette tapes and VHS? They're still backing the internet up on magnetic tape, massive amounts of magnetic tape. And the two people that hold patents that are fighting over who should be the monopoly owner of it are like at court again because magnetic tape can store massive amounts of data, more so than like a flash drive or like a hard drive. And so, no, the internet's backed up. I'm more concerned about an electromagnetic pulse above the atmosphere, but I'm being recorded again. And then, and then it all shuts down. Okay, so on that note, let's take a mental break before we get to our FRQ. Sound good? Mental break. What's that? Modern Warfare 2. That was incredible. Okay, since some of us are working, Some of us are not. And some of us are excited for the answer, which is 99% of us. Yeah, See a way to turn that frown upside down. All right, here we go. So Australia and New Zealand are trading partners. They're besties. Australia is currently in a recession. So there's Australia. They didn't say anything about New Zealand, so I just put them in long run equilibrium at their full potential. So they're just hanging out right there. This says now assume that Australia begins to recover from its recession. So they're getting more money. They're doing better. That would be an aggregate demand, would somewhat probably grew in some way. So they're improving their economy. They're becoming wealthier. They're getting out of the recession. Their equilibrium is closer to their full potential. Using a correctly labeled graph of the aggregate demand and aggregate supply for New Zealand, well, there's why they didn't tell us, because they don't even need us to show this on there, because they're not telling us a location of New Zealand, whether it's an inflation or recession. Show the impact of Australia's rising income on each of the following in the short term. Okay, so Australia got richer. If they're your trading partner and you have more money, are you going to buy more stuff from them? Yeah. What do you buy from New Zealand? Kiwis and Uggs and lamb. Or maybe you go on the Shadow of Mordor tour, right? You can do the tour that follows, like where they went on the Fellowship of the Ring. Okay, whatever. In either case, that's going to grow the aggregate demand in New Zealand. So far, so good? Cool. So what happened to the aggregate demand in New Zealand? Explain. Aggregate demand increased to the right because as Australia became wealthier, they purchased more goods, increasing the net exports of New Zealand. That would be the full featured definition right there. What happened to the output in New Zealand? Well, the output went from wherever it started here at a QE to a Q1, so output grew. There's more GDP, there's more output. All right, still doing good. Using a correctly labeled graph of the money market for New Zealand, show the effect of the output change in part one on the following. An increase in output, we decided, since it doesn't affect population, also is a increase in income, right? So that's a shifter. We have interest rate, and we have our quantity of money. We have our money demand curve. We have our money supply curve. In this case, what happens to the demand for money? As income increases, because our income increased, more money will be demanded to handle more transactions. So it didn't tell us to graph it. I'm just doing it because it helps us understand. So it increased our interest rate. So demand for money increased and our interest rate increased. So far, so good? This one is, yeah. Yeah, because as income increased, they needed to increase the demand for money increased because they needed to pay for all their new transactions. More money, more problems. Want to see what here, let's cheat. Let's go ahead. I wrote it down over here. Let's see, part A, explanation. 1 point is earned for the explanation that higher income means more volume of transactions. Does that make sense? Yeah, more money in circulation. No, I like transaction because it was a transaction cost, right? More money. We have more income, more transactions because the more money you have, the more you're going to treat yourself. So more money needed for more transactions. This one I crossed out for you guys. I'll explain why. It was a trick question. Assume the price level in New Zealand rises. Well, of course it did, right? Because aggregate demand went up. And at the same time, interest rates went up. So they're asking us what's going to happen to real interest rates. We don't know. We can't tell from this graph if inflation went up by 2% and interest went up by 3%, or if inflation went up by 3% and interest rates went up by 2%. And we need to know both our inflation and our expected interest rates to make that work out. So this answer was indeterminate. That was a trick question. Oh. And then finally, although recovering, Australia remains in a recession. and its government takes no action. Where did all my pens go? I bought this. So I threw them. So that brings us back over here. We're still in a recessionary gap in Australia. What's going to happen in the long run to aggregate supply if government takes no action if we're in a recession? Increases, right? Aggregate supply, if we're in a recession, that means our output is less than normal, less people are usually working. Therefore, when people do go back to work, sometimes you work for a lower wage, right? In the long run, we're always going to return back to our long run aggregate supply with an AS1 because in the long run, resource prices and wages are fully flexible. If I didn't have a job and I'm used to making $100,000 and I haven't had a job for 6 months, and someone's like, yo, you want to work? And I'm like, sure. How much are you going to pay me? 75,000. Sounds good because 75,000 is way better than zero, right? So in the long run, wages and resource prices would drop. So aggregate supply would shift to the right, or you could say aggregate supply increases. Cool. So that was an FRQ that had both Unit 3 and Unit 4 in there. You guys having fun with this? I'm having fun with this. And then I'm going to pass out the homework.